Hello. So, hi, I'm there. I'm with Phil today. Again, last week we discussed with Phil how much we can put together in our pension. And this week, I want to discuss with him about the taxes that we pay after we are not around, actually. So, I don't know if a lot of people know about that, but the estate that we build and which we think is going to go to our kids could be liable to inheritance tax. So I want to talk to Phil a bit more about inheritance tax. So Phil is the financial advisor. Phil, do you want to introduce yourself?
Yeah, hi there, Deepti. Yes, inheritance tax is another area that we get asked lots of questions, and it's another area where a bit of financial planning can help those people that do have potentially a problem with inheritance tax, and they'd like to ensure that their estate doesn't pay what can be quite a large bill.
Hmm. Okay, so I guess it's been in news recently quite a bit. So do you want to tell us about what's happening with inheritance
Yeah.
tax?
Well, interestingly, it was in the papers just the other day and reported to say that the government was thinking about actually sort of looking at inheritance tax anyway, maybe thinking of changing it or even abolishing it altogether,
Mhm.
which is maybe a bit of a surprise.
Yeah.
And I think sort of when we delve into this a little bit, the reasoning behind it might be because inheritance tax is, well, it's deemed to be the most disliked tax that there is,
Mhm.
because people look at inheritance tax and say, well, hang on, I've earned this money, I've paid
Mhm.
tax on it whilst I'm alive. How come I need to pay tax on it again when I die?
Mm.
And yeah, that seems like a fair enough point, and that's why it's quite disliked. The other thing, though, interestingly, a survey recently showed that when asked if you were likely to pay inheritance tax, 30% of people thought they were liable to pay inheritance tax, which is quite a difference to the actual figures involved. The last time
Mm.
we've got some figures of this is back in 21, and actually only 4% of estates actually paid inheritance tax.
Right.
That still raised £6.7 billion for the government
Mm.
in taxes, but that's not a massive amount in comparison to, say, income tax. But you can see the disparity there. It shows that it's a confusing tax. People don't understand it too well, and I guess if you therefore withdrew it, you'd probably gain a lot more favour than actually the amount of money that you might lose from it. So I think it's worth perhaps going through what inheritance tax really is, what you are liable to.
Yeah. So what it is. So how much? I mean, yeah. Obviously, I guess we pay when we die and we leave it in our estate. But what are the thresholds? How much do we pay? When do we pay?
Yeah, okay. So the first thing to think of is what's known as a nil rate band. So that's the
Hmm.
threshold for a single person that they won't pay inheritance tax on. And that's £325,000. That's
Right.
quite often the confusing figure. That's not changed for many years, and people therefore assume that that's the figure that they'll pay inheritance tax over, which of course would be quite a number of the population. What they
Mm.
don't remember is the other sort of bits and pieces that come into it. The other part is what's called a residential nil rate band,
Hmm.
and by its name, that's in relation to your home. So
Hmm.
if you leave your main residence to a blood relative, which is usually your children, then you also qualify for the residential nil rate band, and that's 175,000. It's worth
Right.
noting here that if you've got a big estate that's worth more than 2 million, you start to lose that in residential nil rate band. But for most people, it stays in place. So for a single person, you've got the 325 plus 175, which makes £500,000, £500,000.
Right.
Um, then, in addition to that, uh, is the married couples allowance. So if you've got a married couple, you pay no inheritance tax when if the first spouse dies, assuming that that money just gets transferred over to the surviving spouse.
Right.
So if that's what happens, then not only does the money transfer over to the surviving spouse, so does all those nil rate bands. So the £500,000 transfers over to the surviving spouse. So then on the second death, you've got £1 million. So if you've got a normal married couple with children, upon death of the second married couple, then there's £1 million to play with, which is quite a lot different to maybe that 325 that people initially think of. And that's probably where this big disparity comes from between people who think they're going to pay it and actually the people that do pay it.
Okay. So our estate is over £1 million or is up to £1 million, then there's no inheritance tax. Does that mean?
Yeah, that's right. So as long as you're that married couple and you're leaving your home to the children, that's, and which I think in my experience is quite a lot, quite the number of people. But of course, if you have an estate more than that, or you're a single person, then it would be only or you've got no children, then those sort of rates come down. The tax itself is quite a large amount. It's 40%, so it's quite a high rate of any amount that's over and above your own threshold. So if it's a married couple, it's anything over that £1 million mark.
Okay, so essentially, if it's like £2 million, then it will be, so you get £1 million off. So another £1 million you pay £400,000.
Correct. Yes.
Yeah.
Yes.
So
which is quite a hefty amount, isn't it?
Hefty amount. So basically, you can't afford it. You have to sell the house to pay the tax. Then only you get the house, isn't it?
Yes, indeed. And so that's why really it's a good idea to start thinking ahead. There's things you can do. It's not the sort of thing that you start wondering about when you're in your 40s or your 50s, but it is the sort of thing you start wondering about when you're perhaps early retired and moving into your 70s, and certainly by the time you're into your 80s, you should have probably done something if you do have a problem already. But I'll come on to that in a minute.
Okay. And are there any exemptions and reliefs available from inheritance tax liability?
Yeah, so initially you should be making the most of your sort of annual allowances. They may not feel like very much, but they can add up over time. So one that people possibly do remember is there's 3,000 per year that you're allowed to gift away, and that will therefore just not be part of your estate at all when you die. In addition to that, you can give £250 to as many different people as you like, and again, that won't appear. And lastly, if you have a secure income that comes in and you can demonstrate that your gifts are out of surplus income, then that also won't form part of your estate. So with all of those three, though, it's a good idea to keep good records, because if you're ever challenged on this, you need to be able to say, well, yes, but this was clearly within my expenditure. It's clearly within the certain allowances that you've got. And like I say, maybe think about that when you've got a relatively long period of time to consider, and then it can chip away at least at your inheritance tax liability, or at least not make it any worse as you get into, say, retirement.
Okay. So what can somebody do to reduce their liability? Like, I know you said you need to do good planning, and in previous sessions we talk about pension could be a tax-free bundle from is out of inheritance tax scope, out of scope for inheritance tax. So,
well, I'll start on pensions just because that's not normally sort of deemed as being right. We save in a pension because for our retirement to provide us an income, but in more recent times, people have started to think about pensions in that inheritance tax planning space as well. Recently, the lifetime allowance was removed from pensions, which is almost like a pension inheritance tax because it's a nasty tax when you get over the limits. What we find really is when someone gets to retirement, if they've got a hefty pension, nice large pension, but they've also got some good investments, What
Mm,
you used to do would be take that money from the pension, because that's what it's there for.
mm,
However, what you might think to do first is to start to take the income from your investments, which sit
mm,
inside your estate for inheritance tax purposes, rather than the pension that sits outside the estate for inheritance tax. So you start to reduce your estate by taking the money out of the investments first, rather
mm,
than the pension. But yeah, something to consider. I don't think we're perhaps into that point where we're starting to chuck money into pensions to help with inheritance tax, but it's something that we might kind of get to grips with. There's other things that we probably think of first.
mm. Okay. So yeah, what else? What else other than pension? What? How should we plan for inheritance tax?
Well, I tend to sort of work through a list here, and the first one actually is just, you've worked perhaps all your life and you've built up a good estate. Well, number one is spend it,
Hmm.
which might not go against the grain for for a financial planner, but yeah, if you've got the money and you've got the surplus, obviously you have to balance with needing it for the future, but spending money on travel and holidays and things like that aren't an actual asset could well reduce your inheritance tax liability in the future. Um, the next one would be to start giving it away, which sometimes clients do. They might want to actually see their children benefit from a gift rather than wait for them to inherit it when they can't. They're not here anymore. Again,
Mm,
it's a matter of balancing between making sure that you have enough money, but also, maybe being able to reduce your inheritance tax liability as well.
mm,
Once you've gone through those two, the next one that we would often talk to people about is trusts.
mm-hmm,
Um, trust is a form of gifting as well. So you gift money into a trust. So you're starting to lose a little bit of control, but that trust sits outside of your estate after, and this is another thing that people heard a lot about, is the 7-year rule. So
mm,
it's the same with a gift. If you gift into a trust or gift to somebody, that's still inside your estate for when you do the calculation until 7 years have passed. Once
mm,
7 years have passed, you've survived that time, then it sits outside of your estate. If that
mm,
money sits into a trust, there's lots of different types of trusts. You might be able to still take an income from it or take loans from it, or it might just stop your inheritance tax bill getting any bigger. But
mm.
yeah, that's probably the next form or a combination of different trusts that people should look at, as long as time is on their side, to be able to mitigate that inheritance tax liability. Think
Mm.
about trusts.
Okay, but they aren't they taxes on trusts as well? It gets quite
There's
complicated. Mhm.
Yeah, potentially, I
Yeah.
guess. Not always, but if we're talking about big trusts,
Mhm.
trusts that go over and above your nil rate band, and if we remember at the beginning, that nil rate band is 325,000. You
Yeah.
put it into a trust that has the discretion to pay money out whenever it likes, then yes, there are some taxes to consider then, but you
But
therefore
that's
you
very,
need
very
to consider
different.
them.
Yeah. Okay. So probably this is something you do with your clients, help them setting up trusts to put money aside. Um, but it
Yeah,
does require quite a
indeed.
bit of planning.
It's all about succession planning. So it's
Mm,
thinking about the future and how to uh, move money from one generation to another without paying this sort of nasty inheritance tax bill. And there's going to be, over the next few decades, there's going to be a very large movement of money from the people who've
mhm,
got large amounts in estates down to children and to maybe grandchildren.
mhm.
So yeah, that's estimated into the billions, maybe even trillions that will be moved over the next few decades. So there's definitely some planning around those.
Okay. Okay. So yeah, what else we can do?
Well, if you don't like the idea of trusts, you don't like that sort of possibility of losing control to an element, or you don't trust anybody else to look after your money, perhaps, one thing you can do is put a life cover policy in place. Um, what you do there is you work out how much your tax liability is going to be on your debt. So you work out your IHT bill, and then you set up a life policy that is going to pay that bill. So make sure that life policy is written into trust, so that the money doesn't go add to your estate, it goes outside of your estate into a trust, and then your executors have that money there and handy just to pay your bill. So it doesn't stop the inheritance tax having to be paid, but it just gives an ability to be able to pay it. So that's another view. And then lastly, it's perhaps sort of a one that our clients might already benefit from, which is known as business property relief. This is very much there in relation to small businesses. So if we have clients who've got a small business already that has a value to it, then there's every chance that that business qualifies for what's known as business property relief. Business property relief is there because if you die, what the government doesn't want to have to do is make you sell your business to pay an IHT bill. It wants you to be able to, your family perhaps, to take over that business and to continue to run it, because they'll make more tax over the period, over a long period of time, by doing that than they will by one hit of inheritance tax. And because of that, then you get some sort of clever people that put that sort of situation into someone who hasn't necessarily got a business. So if you don't have a business, you can still invest into other businesses that do qualify for business property relief, and they're packaged up. By their nature, they tend to be smaller businesses, so the risk is a little bit higher. So that's a downside, but a plus side is that if you invest in business property relief, the money that you invest in it is outside of your estate in just 2 years. So it's a lot quicker. It tends to be perhaps two types of clients this works for. One, someone who's a little bit older, so therefore thinks, I don't have 7 years, or I'm a little bit worried as to whether I can survive 7 years by putting this money into trust. So they might think of business property relief. Or otherwise, it might be a business owner who sells their business. So if they sell their business for a lot of money, suddenly they've gone from having that money sat inside the business and therefore exempt from inheritance tax, suddenly it's inside their estate. So putting that money into business property relief investments can then keep it outside of their estate, as long as they act reasonably quickly. So you see there's kind of a few different processes to go through, and some things will work for people and some things won't work for people. It's very much an individual circumstances to see what works best for you and what you'll feel most comfortable with.
So I can see it's quite complicated when it gets eventual planning on inheritance tax. So it's always a good idea to have a financial advisor on your side. And I guess for everyone, if, as you see, if you sold a business and you have big chunk of money and you think your estate could be liable for inheritance tax, it's definitely a good idea to get a financial advisor on your side and put some planning in place, such as pensions, trusts, etc. And then, making sure, our kin gets the best out of what we want to give them. So thank you so much, Phil. I think that's really good roundup of inheritance tax. Is there anything else you want to add?
I don't know. Do you ever get any questions about inheritance tax?
Yeah, so I do get questions like people who are receiving inheritance from their parents who are not in UK, outside UK. So I believe, what's your stand on that?
This can get a little bit complicated, but you basically it's a thing called domicile. If you are UK domicile and you die, then your worldwide assets are subject to inheritance tax. But if you're not UK domicile, then your worldwide assets aren't subject to inheritance tax, only assets that are held in the UK. So if you've got someone who's a client who lives in the UK, but their parents live somewhere else,
then the
then
local country.
you're not going to be paying. They shouldn't be liable to inheritance tax. But obviously, different countries have different rules, and so you need to know the local rules. But
Yeah.
It's a sort of quite a strange thing called domicile, and it's usually your domicile and your residency for income tax can be the same, but they could be different. So it's worth getting checked out as well.
Okay, yeah. So it's basically, the person who's giving, their domicile is important, not the person who's receiving, isn't it?
Correct,
As
yes.
against the usual taxes, when it's mostly the person who's receiving the income, their domicile is important. So yeah, that's interesting. So yeah, I think that's really good. I think a good roundup on inheritance tax, and we'll see what happens in future, and hope they reduce it or scrap it. This nasty tax.
Yeah, I really don't know what they might do to it. I should imagine they'll do something, perhaps, because it's quite complicated, isn't it? It could be simplified. Maybe they'll raise the rates, those thresholds a little bit.
Make it a bit more simple, and not so harsh that you have to sell your house to pay the inheritance tax kind of things. So yeah. Okay, so sounds good. So maybe next week we're going to speak about a limited company, how to get finances, how to raise funds for the limited company. So I think that's it for now from me and Phil. Thank you so much.
Speak to you next week.